Did you hear that? That wasn't just your stomach rumbling for a burrito bowl. That was the sound of Chipotle's stock price taking a nosedive. What's going on with one of America's favorite fast casual chains? Why is Wall Street suddenly getting a bad case of indigestion over Chipotle? We're going to break it all down, from the boardroom to your burrito, and figure out what this means for the company, for investors, and even for you, the customer. Stick around because this story has more layers than a 7-layer dip. So, let's get right into the spicy details. Recently, Chipotle's stock, ticker symbol CMG, experienced a significant drop. We're talking about a serious plunge that had investors and market analysts reaching for the antacids. This wasn't just a minor blip. It was one of the most dramatic single-day drops for the company in recent memory. The big question is, why? What caused this sudden loss of confidence from Wall Street? The primary trigger was the company's own forecast. During their latest earnings call, Chipotle's management team announced that they were cutting their future sales and profit projections. In the world of finance, this is like a chef admitting they're running low on guacamole. It sends a signal of uncertainty. When a company as strong and consistent as Chipotle says, "Hey, we might not make as much money as we thought we would," investors get nervous. They start to wonder if the incredible growth story that has defined Chipotle for years is finally starting to cool off. To understand the concern, you have to look at what Wall Street values: predictable, consistent growth. For a long time, Chipotle was the golden child. They had a simple, effective model: fresh ingredients, customizable meals, and a strong brand identity. This formula led to explosive growth, with new stores opening up and sales climbing quarter after quarter. Investors loved this story, and they rewarded the company with a very high stock valuation. But when the company itself signals that the path ahead might be a bit rockier, that high valuation comes under intense scrutiny. Is the company still worth that premium price if its growth is slowing down? That's the question that led many to hit the sell button. Let's dig a little deeper into the specific reasons behind the lowered forecast. What's actually causing the slowdown? One of the biggest culprits is something we're all feeling in our wallets: inflation. The cost of everything, from avocados and beef to packaging and labor, has been on the rise. Chipotle has been trying to manage these rising costs, but it's a delicate balancing act. To protect their profit margins, they've had to raise their menu prices. You've probably noticed your favorite burrito bowl is a bit more expensive than it was a year or two ago. This is where the concern really starts to brew. There's a limit to how much customers are willing to pay, even for a brand they love. Wall Street is worried that Chipotle might be reaching a price ceiling. If they raise prices too much, they risk alienating their customer base. People might start choosing cheaper alternatives, or maybe just eat at home more often. This is a classic economic squeeze: rising costs on one side and price-sensitive customers on the other. The company's lowered forecast suggests that they are seeing signs of this pushback in their sales data. Perhaps traffic to their stores isn't as strong as they had hoped, or people are ordering less to save money. Another factor at play is the broader economic environment. With talk of a potential recession and rising interest rates, people are generally becoming more cautious with their spending. That daily Chipotle run might become a weekly treat. Discretionary spending, which includes eating out, is often one of the first things people cut back on when they're worried about their finances. So, Chipotle isn't just battling rising food costs, they're also navigating a landscape where their customers are tightening their belts. This macroeconomic headwind makes it much harder to predict future sales with confidence, hence the more conservative forecast. It's also important to remember the context of Chipotle's past. The company staged one of the most impressive corporate comebacks in recent history after its food safety scandals nearly a decade ago. They rebuilt trust, revamped their processes, and won back customers, leading to a period of phenomenal growth. This success set a very high bar. Investors became accustomed to seeing amazing numbers, and anything less than that can feel like a disappointment. So, part of this stock reaction is about managing expectations. The growth couldn't stay explosive forever. At some point, the law of large numbers kicks in. As a company gets bigger, it becomes much harder to maintain the same percentage growth rate. It seems Wall Street is now grappling with the reality that Chipotle is transitioning from a high-flying growth stock to a more mature, stable company. So, What is Chipotle doing about all this? They're not just sitting back and watching their stock fall. The company has a multi-pronged strategy. First, they are focusing heavily on operational efficiency. This means finding ways to streamline processes in their kitchens to serve customers faster and more accurately, especially for digital orders, which now make up a huge part of their business. Faster service means more sales per hour and happier customers. Second, they are continuing to innovate with their menu, but in a very strategic way. You might see new limited-time offerings like different protein options or unique beverages, designed to create buzz and bring people into the stores without overhauling their core menu. These new items can drive traffic and encourage customers to spend a little extra. Third, and perhaps most importantly for long-term growth, is their focus on Chipotlanes. These are the drive-thru lanes dedicated to picking up digital orders. This is a game changer. It combines the convenience of a traditional drive-thru with the efficiency of modern digital ordering. Chipotlanes are incredibly popular and highly profitable. The company is aggressively adding them to new and existing restaurants, and they see this as a major engine for future growth. It addresses the customer's need for speed and convenience head-on. So where does this leave us? Is this a sign of the guac-apocalypse for Chipotle, or is it just a temporary dip? From an investor's perspective, the story has become more complex. The days of easy, guaranteed growth might be over. The stock is likely to be more volatile as the company navigates these economic challenges. However, for long-term believers, the core strengths of the brand remain. Chipotle still has immense brand loyalty, a focus on fresh ingredients that resonates with modern consumers, and a clear strategy for growth with initiatives like Chipotlanes. For us, the customers, this whole situation is fascinating. It's a real-time lesson in business and economics. The price of your burrito is directly linked to global supply chains, inflation rates, and Wall Street expectations. While we might grumble about paying a little more, it's also a testament to the brand strength that so many of us are still willing to do so. The company's challenge is to keep providing enough value to make it worth our while. In conclusion, the cratering of Chipotle's stock isn't about bad food or a failing company. It's about a shift in expectations. It's the story of a high-growth superstar adjusting to a new, more challenging economic reality. The company is facing real headwinds from inflation and cautious consumers, and its solution lies in operational excellence, smart innovation, and the expansion of its successful digital and drive-thru formats. The next few quarters will be crucial to see if their strategy pays off and if they can win back the full confidence of Wall Street. It's a spicy situation, and you can be sure we'll be watching closely. Thank you so much for joining me on this deep dive into the business of burritos. If you found this breakdown interesting, please give this video a thumbs up. It really helps the channel. And for more content that unpacks the stories behind the brands you know and love, make sure to hit that subscribe button and ring the bell so you never miss an update. See you in the next video.